Welcome back, traders. In this video, we are diving into the most powerful order block trading strategy, okay, which is order block in an order block. Now, this is an advanced smart money concept, but once you understand it, it becomes one of the most precise ways to trade in the Forex market. First of all, let us quickly recap what an order block is. Okay, an order block is essentially the footprint of institutional buying or selling. All right, so we had a change of character here, right? And what led to this? The last bullish candle, have that here. Okay, so an order block forms when banks or large institutions place significant orders that drive the market in one direction. For us as traders, these areas act as strong supply or demand zones because price often revisits them before continuing its move. Okay? Now, what makes an order block in an order block is so powerful? Imagine you are looking at a higher time frame, like the 4-hour chart. Let's assume that you identify a bearish order block, you know, and then inside that same zone on a lower time frame, let's go to a lower time frame, for example. So inside that same zone on a lower time frame, like the maybe 15-minute time frame, you notice another refined order block forming, right? Like what we can see happen here. So in this case, last bullish candle, we're going to be having this, right? So when this happens, it shows a layering of institutional activity, right? It's not just one zone of interest, it's a confirmation inside another confirmation. So this nested setup creates precision. Instead of entering anywhere inside the large order block, you now have a smaller, refined zone to focus on. This allows for tighter risk management and a more accurate entry point. You are essentially trading where liquidity is most concentrated. Okay, so let's go step by step. The first step is to identify the higher time frame order block, and you can use the 4-hour as your higher time frame. So this gives you your main area of interest. Remember that to identify your order block, you have to look out for a market structure shape, for example, a break of structure or a change of character. So if you previously had a bullish trend, like in this example, we had a bullish trend and then suddenly we had a break of that bullish trend line and then price dropped below the last low. So that's going to be a change of character. So you have to identify the last bullish candle before that impulsive move, and that gives us our bearish order block. So the reverse is the case for a bullish order block. Okay, so now the next step, the step 2, is to now drop to a lower time frame. You can use the 15 minutes, for example, as a lower time frame, and you're going to be looking for another order block forming within or inside that bigger zone. So this is the nested order block. Okay, then step 3 is to wait for price to return to this refined area, because two other blocks overlap. The chances of price reacting are much higher, right? Now, why does this happen? Institutions don't place all their orders at once. They often scale in. A large block may represent the beginning of their position, but smaller blocks inside it represent additional scaling or refined levels where they accumulate. And that is why we often see strong reactions when price revisits these nested areas. So here's a tip. Always pay attention to market structure alongside other blocks. If the structure aligns with your nested block, you have a much stronger setup. For example, if the higher time frame is bearish and your nested order block is bearish, right? A bearish nested order block inside a bearish, higher time frame order block. That's a powerful confluence. All right. So that's basically it. Okay. But it does not necessarily mean that price will always respect that other block. Price may not always respect it. There's no strategy that's 100% guaranteed. So at the end of the day, sometimes that level might still get broken, or price might not even eventually touch it, right? You know, as soon as you expect. Okay, so you have to always keep your expectations in check and ensure that you always practice good risk management. All right. So let's just see if we can find another example briefly before we round up. Okay, so here we had a break of structure, and then the last bearish candle, which was this. Okay, so this one was mitigated. Let's go to a lower time frame. Let's check whether we are going to find what I'm going to do is I'm just going to mark that zone so that we can be well informed. Okay, so now let's go and look for where it possibly formed on the or where the lower time frame gave us an order block. Okay, so let's just use the 30 minutes for our lower time frame. Okay, so in this case we had a change of character around here, right? And then because of that, we have an order block around here. All right. Okay, this was where the mitigation occurred. Okay, so we should be looking at this point. Yeah, this is the point we're supposed to be looking at because this is where the mitigation occurred. So we had a break of structure here. We had a break of structure here. And then this is now going to be our order block. Yeah, you can see the last bearish candle. That was going to be our order block. So now if you look closely, you will see that price respected this smaller time frame order block. Can you see? You can see this one was for the bigger time frame and it got respected quite all right, but precisely this smaller time frame order block, you can see it got mitigated. So had it been you had entered here, you'll notice that your risk will be lower compared to if you had entered here. So to summarize, an order block in an order block is the most powerful order block trading strategy because it gives traders accuracy, precision, and a deeper understanding of institutional activity. If you found this breakdown valuable, make sure to hit that like button and subscribe for more Forex trading education. Thank you for watching. I look forward to seeing you in the next video. Happy trading.